Hello everyone, this is ACCA Amit Kumar and we'll discuss consolidation in 5 steps. So when I say consolidation in 5 steps, you may be wondering that how can this complex mechanism of consolidating the financial statements of two companies can be done in just 5 steps. Yes, it is possible. So when we are consolidating financial statements, the standards applicable are mainly Ind AS 28, investment in associates, Ind AS 103, business combinations, Ind AS 1110, consolidated financial statements, Ind AS 1111, joint arrangements, Ind AS 112, disclosures. So the main calculations or the main workings which we get to know through Ind AS 103 business combinations is calculation of goodwill and valuation of NCI. And on top of this, fair value adjustments. Since the requirement is that we need to fair value the net assets on the date of acquisition. Ind AS 1110 mainly deals with the consolidation procedures, deals with the principles like asset of one entity and liability of another gets cancelled on consolidation. Asset of one entity and liability of another gets cancelled on consolidation. Eliminating intra-group transactions in P&L. Elimination of intra-group transactions. Treatment of unrealized profits. On sale of goods and sale of assets. And adding line by line assets of parent with assets of subsidiary, liabilities of parent with the liabilities of subsidiary. So the main area which requires attention is calculation of goodwill, valuation of NCI. So goodwill is on the debit side, which is present in the consolidated balance sheet because it helps in using this principle, asset of one entity and liability of another gets cancelled on consolidation. This goodwill is present in the consolidated balance sheet because it replaces investment in subsidiary, and on the credit side it replaces the net assets which were acquired on the date of acquisition. So we include only post acquisition profits. So the net assets changes. So we need to know the valuation of group retained earnings after consolidation, that is the earnings of the parent with the post acquisition earnings of the subsidiary. We get to know the group retained earnings. So the major adjustments are goodwill, valuation of NCI, group retained earnings. These are the three major adjustments which help in controlling the consolidation of financial statements. So if we are able to target these three workings, we are able to do majority of the calculations relating to consolidation procedures. Is the reason the steps I wish to share with you, the 5 steps I wish to share with you are mainly targeting these three. So working note number 3 is goodwill. Working note number 4 is valuation of NCI. Working note number 5 is group retained earnings. Working note number 2 is about the net assets of subsidiary on acquisition. But without working note number 2, will not be able to perform working note number 3 and 4. So working note number 2 is essential. And working note number 1 sets the tone for performing a consolidation question. So if I write all those workings are working note number 1, group structure. Working note number 2, net assets of subsidiary on date of acquisition and date of balance sheet. Working note number 3, calculation of goodwill. Working note number 4, valuation of NCI, and working note number 5, group retained earnings. So as I said, three main workings, like the valuation of working note number 2 helps us in calculating working note number 3, 4, and to some extent 5 as well. And these are the major workings to be done in a consolidated balance sheet question, or when we are preparing financial statements in real life. These are the main areas which we need to focus on. So this is what we are trying to achieve through this discussion. If I share a brief of the standards applicable, since I have written all the standards, I should tell what is the role of each standard. Ind AS 28, investment in associates and joint ventures, is the standard for dealing with associates and joint ventures who have significant influence in joint control, wherein we follow equity accounting. Equity accounting is the investment made in an entity which increases with the share of profit or decreases with the loss, decreases with any dividends received. So equity accounting is simply when you are measuring the performance on the basis of how your investment has grown, cost of investment plus share of profit from associate or JV less dividends. When you calculate your investment in this method, this is known as equity accounting. You are interested in the equity portion of that entity. So Ind AS 103 business combinations. Is the standard for valuation of goodwill and guides us on how to value the net asset subsidy on the date of acquisition, how to calculate goodwill, what if there is positive goodwill or negative goodwill. If there is positive goodwill, we record it as part of the balance sheet. If there is negative goodwill, we show it as part of capital reserve. Ind AS 1110 consolidated financial statements is defining the definition of control, assesses control. So there is a complete assessment whether an entity controls another entity on the last day of the reporting date, they are required to present consolidated financial statements. So the consolidation is needed if in our assessment an entity is controlling another entity on the last day of the reporting date. If they are controlling another entity, they are mandatorily required to present consolidated financial statements. In spite of being in dissimilar businesses, they still have to present consolidated results. In trying to present consolidated results, we need to follow the consolidation procedures mentioned in Ind AS 1110. Ind AS 111 joint arrangements is simply a standard which guides us to identify joint arrangements, and if there are joint arrangements, whether they are joint operations or joint ventures. This guidance helps us to identify the difference between operations and ventures, and accordingly we'll apply the standard relevant for accounting for operations or ventures. If it is a venture, Ind AS 28 gets applicable. If it is a joint operation, then Ind AS 1110 gets applicable. Ind AS 1112 deals with the disclosures relating to consolidation. Whatever we have done relating to all these standards, this takes care of the consolidation standards. So when I say consolidation, I do not mean consolidation by just one accounting standards. There is confusion sometimes in the minds of many that which standard is applicable in consolidation. So if someone is talking about consolidation, they should understand consolidation in the context of Ind AS 28, Ind AS 103, Ind AS 1110, 1111 and 1112 together forms the consolidated financial statements preparation. And understanding of all of them together makes our life simpler, and whosoever is performing these consolidation procedures, their life will also be easy. So if you remember these 5 steps, like we can easily perform consolidation working. So what is to be done in working note number 1? To begin any consolidation question or to begin any such consolidation procedure, always understand first what you need to do. So this is very helpful for preparation of a balance sheet. You should identify the parent, subsidiary, if there is any associate or JV, if there are normal trade investments, you can highlight them as well, whether they will be measured at FVTPL or fair value through OCI. This is coming in from Ind AS 109 financial instruments. This is covered in Ind AS 109 financial instruments. Associates or JV covered in Ind AS 28. So working note number 1 defines the group structure. We should clearly identify the group structure. And once we've identified the group structure, we should clearly mention the date of acquisition, date of balance sheet, so that we know since when we can include post-acquisition earnings. And if it is a mid-year acquisition, we should mention the number of months and the percentage of acquisition. The percentage acquired in each and non-controlling interest. Once this is identified, once this is clear what we are going to do, then we move on to working note number 2 to identify net assets or subsidy. So we need net assets subsidy on 2 dates. One is date of acquisition, date of balance sheet. Now this working will help us to perform workings of working note number 3, calculation of goodwill, valuation of NCI, and also will help us to know how much will be the share of profit of subsidiary post acquisition. So this working is very crucial, and if we understand from the P&L perspective, this is indirectly the profit and loss of the subsidiary. Working note number 2, net assets of subsidiary, is indirectly the P&L of subsidiary. So we write the share capital of subsidiary on date of acquisition, date of balance sheet, the retained earnings position on date of acquisition, date of balance sheet. Suppose share capital on the date of acquisition is 100,000, retained earnings on date of acquisition was 150,000, and now it is worth 190,000. There can be other components of equity which were standing at 5,000 and now they are worth 9,000. Then there are fair value adjustments. This is a requirement of Ind AS 103 business combinations, that we need to fair value all the assets and liabilities on the date of acquisition. In that we'll get to know that land is higher by 50,000. Date of balance sheet, since it is non-depreciable asset, remains the same. Plant and machinery is higher by 40,000, but the remaining useful life is 80 years. So suppose 1 year has passed from the date of acquisition to the date of balance sheet, then the date of balance sheet figure will be 32,000. If it is 8 years, then 40,000 divided by 8, 5,000 depreciation, and if 1 year has passed from the date of acquisition, then 35,000 is the date of balance sheet amount, resulting in 40,000 minus 5,000. 5,000 is because 40,000 is depreciated over a period of 8 years. There may be an intangible asset which gets recognition for the first time because it was in development stage, and on date of acquisition it was included at 15,000. On date of balance sheet it is an intangible asset with indefinite life, so suppose we include it at the same amount. Indefinite life, so no depreciation. Depreciable component, non-depreciable, not depreciated. This is not depreciated because having an indefinite life. So we need to know what is their value on the date of acquisition and what is their value on the date of balance sheet. What is the change in their value because of depreciation, amortization. If there is any inventory which is higher by say 4,000, it may happen that by the date of the balance sheet we may have sold that inventory, so you may not find any inventory relating to it at the end of the year. As far as deferred taxes are concerned, if the rate of tax is say 20%, now we believe that we'll be earning these amounts in the time to come. 109,000 will be the earning in the time to come. So deferred taxes applicable on fair value adjustments does impact goodwill valuation. So we need to charge deferred taxes on the expected earnings in future. The expected earnings in future are 109,000. So 20% on it, 109,000 will be 21,800 will be the tax, and the earnings on date of balance sheet expected are 1 lakh. So minus 20% into 1 lakh. So deferred tax liability balance on the date of acquisition is 21,800. This is the amount to be included in the balance sheet. On the face of the balance sheet, detailed balance will be minus 20,000. Minus 20,000 means increase in liabilities. Since we are targeting the net assets of subsidiary, is the reason minus. Assets are positive, liabilities are negative. So net assets position at the end of the year turns out to be equivalent to 342,200, which on the date of balance sheet turns out to be 379,000. So if you look at the difference, 379,000 minus 342,200, this gives us the post acquisition earnings. But in this earning, if you notice, there is a other component of equity as well. So if there was no other component of equity, then the entire earning would have been related to the retained earnings. But now since there is another component of equity, we'll need to bifurcate this difference of 4,000 separately. So total earnings are 36,000, but this earning of 4,000 will be dealt with separately now. So minus 4,000 is equal to 32,800. This earning will be divided between parent and NCI. Suppose when we first acquired it in our group structure, it says that parent acquired 80% stake and 20% belongs to NCI. And if 80% belongs to parent, 20% belongs to NCI, then out of this 32,800 and this 4,000, 80% of this belongs to the parent, 20% of it belongs to NCI. This will go to group retained earnings, and this will go to other comprehensive income, that is OCI. The parent and NCI has a share in it of 3,200 and 800. So this is how the post acquisition earnings will be divided between what will go to retained earnings and what will go to other components of equity. So parent share is presented in working note number 5. NCI share will be presented in working note number 4. This we could have dealt with directly as well, because NCI share in any way, in any case, is equal to 7360, which we could have applied directly 20% of 36,800 non-controlling interest share post acquisition. We could have got it directly as well, 20% of 36,800 7360. So for NCI there is no problem, we don't have to bifurcate it in terms of OCI or group retained earnings. It's only for parent we need to divide the earnings into what belongs to group retained earnings and what belongs to other components of equity. So this working will help us in moving on to working note number 3. Working note number 3 is calculation of goodwill. So we'll need to calculate the goodwill, we'll need purchase consideration. Purchase consideration may be a combination of cash, stock exchange, it may be deferred consideration, it may be contingent consideration, and value of NCI, either on proportion basis or fair value basis. And this will be compared with fair value of net assets of subsidiary on date of acquisition. This figure we'll get to know from working note number 2. Fair value of net assets to subsidiary on date of acquisition is 342,200. Fair value of net assets to subsidiary on date of acquisition. Purchase consideration may be cash, say 1 lakh. For every 5 shares acquired in, so 80,000 shares acquired, for every 4 shares acquired, 1 share issued at the rate of, say, at the rate of 6 per share. So 1,20,000 due to stock exchange. Deferred consideration will pay 108,000 after 2 years. So what is the present value of this 108,000 after 2 years? We'll get the discounting factor. Suppose the discounting factor, deferred consideration at the rate of 10%. Discounting factor for 2 years is 1 divided by 1.1 raised to power 0.826. So 108,000 into 0.826. 89208 is the discounting factor for 108,000 for a 2-year period. So deferred consideration is included in today's terms, that whatever amount we are going to pay in future will discount it to present value, include it as part of the purchase consideration today. There will be contingent consideration. Now this is deviating from the standard IAS 37 provisions, contingent liabilities and contingent assets. You may feel that this has a relationship with the contingent liability of IAS 37. It is based on it, but the accounting is related to Ind AS 103 business combinations, which says that if there is any contingent consideration which is dependent on occurrence or non-occurrence of a future event, which may happen, which may not happen. So whatever is the probability of amount to be paid in future, we'll include it at the fair value of contingent consideration today. So we need to involve a valuer who will give us the fair value of contingent consideration today is, say, 25,000 is included as of today. Now, as I mentioned earlier as well, that in Ind AS, whatever we are measuring at fair value model, fair value less cost to sell, fair value through P&L, fair value through OCI, we are required to remeasure it on each reporting date. So in case of this contingent consideration which is being measured at fair value, we should remember to include the fair value of contingent consideration on the reporting date as well. This we are doing this fair valuation on the date of acquisition. Purchase consideration on the date of acquisition. Now value of NCI will be either on proportional basis or either on fair value basis. Let's first try it on proportionate basis. If I include the value of NCI on proportionate basis, that means the net assets of subsidiary on date of acquisition were mentioned at 342,200. 20% of this amount, 20% of 342,200 will belong to NCI. So when we total up, we get to know that the total is 402,648. The total purchase consideration is 334,208. When we measure the purchase consideration plus value of NCI minus fair value of net asset subsidy on date of acquisition, this difference is known as goodwill. So the value of NCA on proportionate basis had a role to play in calculation of goodwill. Now when we are valuing NCI on proportionate basis, this goodwill is known as partial goodwill. This is belonging to parent only. Why we are highlighting this fact that on impairment we should not charge any impairment to NCI. The impairment loss is belonging to parent only, so we do not charge anything to NCI. So valuation of goodwill is dependent on valuation of NCI. The same calculation if you would have done for value of NCI on fair value basis. This was value of NCI on proportion basis. This is value of NCI on fair value basis. This is going to change. Fair value of net asset subsidiary on date of acquisition. This fair value basis will change. Now there are 20,000 shares belonging to NCI. Suppose the value of each share is 4 per share. So 80,000 is the value of NCI. Everything remaining constant. In calculation of valuation of goodwill, everything remaining constant, the only one thing can have an impact on calculation of goodwill. How did we value NCI? If we valued NCI on proportion basis, this is partial goodwill belonging to parent only. But if the same we valued NCI on fair value basis, that is the fair value of the share in the market, then the goodwill is known as full goodwill. It is belonging to parent plus NCI. The relationship is simple that if this goodwill gets impaired, then the impairment loss is allocated to group retained earnings as well as NCI, because the goodwill is belonging to parent as well as NCI. In case of partial goodwill, the goodwill is only impairing in case of parent, since the goodwill belongs to parent only. So that's the difference it makes when we value NCI on proportionate share of net assets or fair value basis. The workings done in working note number 2 had a direct relationship with working note number 3. Working note number 3, the calculation of goodwill was totally dependent on fair value of net asset subsidiary on date of acquisition as well as on value of NCI. Working note number 4 is valuation of NCI, non-controlling interest, on date of balance sheet. Now depending on how we valued NCI initially will determine the value of NCI on date of balance sheet. So value of NCI on date of acquisition fair value basis, then it will be equivalent to 80,000 plus share of post acquisition profits of NCI. We'll mark working note number 2 and we'll include it from there. Post acquisition profits were 7360. Suppose goodwill was impaired by 10,000. Then impairment of goodwill. So goodwill we calculated was 72,008. Suppose goodwill got impaired by 8. So the impairment loss is divided between parent and NCI on proportion basis. 80% of the loss will go to parent and 20% of the loss will go to NCI. So impairment of goodwill minus 8,000. The value of NCI on date of balance sheet is 79360 is the value of NCI on date of balance sheet. Same value of NCI on proportionate basis. Value of NCI on date of acquisition if the NCI was valued on proportionate basis. Then the value of NCI would have been 68440. Share of post acquisition profits 7360. Value of NCI, impairment of goodwill is not allocated to NCI if NCI valued on proportionate share of net assets. The same we could have calculated value of NCI on date of balance sheet by directly applying the percentage 20% of net assets of subsidiary on date of balance sheet. So net assets of subsidiary on date of balance sheet is equaling 379,000. %20 of 379,000. How did I get it? I got it from working note number 2. You can do it directly if you are valuing NCA on proportion basis. And 20% of 379,000 is equal to 75,800. So this is also possible. So mathematics is a choice. This is also possible if you're valuing NCA on proportional basis, and if you're very confident of your valuation on date of balance sheet, you can use this method as well. This was changed. Like, why this was changed? Because the calculation of goodwill has gone through a journey. Like earlier we were valuing NCI only on proportionate basis. Then there was a change that NCI should be valued on fair value basis. So the manner of presentation changed. Otherwise the same thing which is being presented on proportionate basis like this The same thing which is being presented on proportionate basis in this manner used to be presented like purchase consideration, same. This was being compared with, now this purchase consideration was being paid for acquiring 80%. So it made sense to compare the fair value of purchase consideration for acquiring 80% compare with, here we were comparing the fair value of net asset subsidiary on date of acquisition, the entire 100%. If you notice, this was being paid for acquiring 80%, value of 20% being compared with 100% fair value of net asset subsidiary. So before there was a choice available in valuation of NCI at ISP's level when IFRS 3 business combinations was introduced. We used to value it directly. Why I'm saying we used to value directly, because I learned IFRS into my curriculum in 2007 as part of my ACC qualification. And when we were valuing goodwill, we were not valuing in the manner it is being presented today. We were valuing it directly by comparing the purchase consideration with fair value of net assets acquired. Fair value of net assets acquired, which was 80% of 342,200. 80% of 342,200. Two 73760. So the goodwill so calculated purchase consideration minus fair value of net assets acquired 60488. There was no concept of partial or full goodwill. The goodwill was belonging to parent only. Goodwill was belonging to parent only because we were only calculating parents only goodwill. We were not calculating NCI's share in it. So this was the manner of presentation. This was a direct manner of presentation. We were comparing 80% with 80%. 80% being compared with 80% acquired. 80% purchase consideration was being compared with 80% acquisition. So the goodwill was belonging to parent only. So later there was a choice given in valuation of NCI. So here NCI was valued on proportionate basis. There was no choice provided. So when the choice was given, the manner of presentation of goodwill changed. We started presenting it like this because the goodwill was impacting the valuation of goodwill. So if NCI was valued on proportionate basis, goodwill was belonging to parent only. NCI valued on fair value basis, goodwill was belonging to parent plus NCI. Which had an impact on valuation of NCI on date of balance sheet as well, which was directly done. 20% of net assets on subsidiary on date of balance sheet, we were directly applying the percentage and getting the value of NCI. But after we introduced this choice in NCI valuation, we started presenting it in this manner. This is the new way of presentation. Because here we need to share the value of NCI, which can be on fair value basis, which can be on proportionate basis. Working note number 5 is group retained earnings. Group retained earnings means parents' earnings plus share of post acquisition earnings which we get from working note number 2. I assume parents' earnings were say 1,90,000. Share of post acquisition earnings is equal to we get from working note number 2, post acquisition earnings were equal to 26240. In it, if there is any deferred consideration, we need to do unwinding of deferred consideration. So if you remember, we purchased on deferred consideration 108,000 was discounted to present value. The present value was 89208. The unwinding of discount will be on 89208 at the rate of 10%. (10% of 89208 is equal to unwinding of discount on deferred consideration. There was contingent consideration as well, which we included at fair value on the date of acquisition. The contingent consideration was fair value on the date of acquisition was 25,000. Suppose the fair value of contingent consideration now is 29,500. So that means the liability has increased by 4,500. So this liability will be measured at fair value, or any change in fair value measurement measured at fair value through P&L, fair value through OCI, fair value less cost to sell is required to be remeasured on each reporting date. In this case, the difference is to be taken to P&L. The liability has increased by 4,500, increased from 25,000 to 29,500. So there is a change in fair value by 4,500. A change in fair value increases the liability. So less change in fair value of contingent consideration minus 4,500. We also included impairment of goodwill. Impairment of goodwill in working note number 3. How much was that? Impairment of goodwill in working note number 3, it was 8,000. There was an impairment of 10,000. We allocated 8,000 impairment to the parent. So we'll be including that impairment of goodwill here minus 8,000. Apart from this, if there is any unrealized profit on sale of goods, unrealized profit on sale of goods to subsidiary will be included here. Suppose goods worth 10,000 sold at a price of 15,000. Goods worth 10,000 sold for 15,000. All the goods remain in inventory. So there is an analyzed profit of 5,000 which is inherent in inventory. So we'll reduce this analyzed profit, and on the face of the balance sheet we'll eliminate the valuation. From the valuation of inventories we'll eliminate 5,000 of analyzed profit on sale of goods. If subsidiary sells goods to parent, then the adjustment of analyzed profit could have been done in working note number 2. If we make the adjustment in, so this working note number 2 is indirectly the P&L of subsidiary. So if subsidiary is selling to parent, it makes sense to make the adjustment of unrealized profit in working note number 2. When we make the adjustment in working note number 2, we'll be successful in eliminating that unrealized profit, and it will automatically be allocated between parent and NCI because we are allocating the post-acquisition profits after this adjustment. If parent sells to subsidiary, the profit is in the parent's books, which can be eliminated in working note number 5, which is indirectly the P&L of the parent. So working note number 5 is indirectly the P&L of the parent. Working note number 2 is indirectly the P&L of subsidiary. So if there is any adjustment to be made in the books of parent, we'll make it in working note number 5 related to P&L. If any adjustment related to subsidiary, we need to make in the books of related to P&L of subsidiary, we'll make those adjustments in working note number 2. So hope I have been successful in sharing the insights on these 5 important workings, which can really be helpful for controlling the consolidation question and also keeping an eye on every adjustment so that we do not forget it. We keep a track of all the adjustments and we can do them together. So any other adjustment impacting the P&L of parent will be coming in here. So this is group retained earnings. So in the consolidated statement of financial position, consolidated statement of financial position, as on 31st December 2000, we'll mention non-current assets, current assets, equity, non-current liabilities, and current liabilities. So if I fit in the major adjustments, which we did in these 5 workings, among the non-current assets, the investment in subsidiary gets replaced with goodwill. Investment in subsidiary is replaced by goodwill. In the current assets, we need to remember the inventories valuation will have less unrealized profit of 5,000. The property, plant and equipment or other assets, PPE, intangibles, will have fair value adjustments after depreciation amount. So So include the date of balance sheet amounts from working note number 2. Working note number 2, date of balance sheet amount will be including. Working note number 2, date of balance sheet amount will include. Goodwill will get from working note number 3. Then in the equity we only include share capital of parent only. Share capital of subsidiary gets cancelled with investment in subsidiary. Share capital of subsidiary gets cancelled with investment in subsidiary. Asset of one entity and liability of another gets cancelled on consolidation. So investment in subsidiary over and above the net asset subsidiary, that is share capital, retained earnings on date of acquisition, the over and above amount of net assets which you acquired on date of acquisition is represented as goodwill. Is the reason we present share capital of parent only because the asset of one entity and liability of another gets cancelled on consolidation. So we'll include only group retained earnings, which includes post acquisition earnings. So working note number 5. So we'll include goodwill after impairment, so goodwill will be included after impairment in the books at 62,008. Group retained earnings included in the balance sheet at 189,819. Apart from this, we need to include other components of equity whatever is parent share plus share from subsidiary which was post acquisition earning, which was 3,200. So total earnings which are divided into parents earnings, and this was supposed to be working note number 6, 3,200 to be included as part of other components of equity. So parent share of other components of equity plus 4,000 derived from working note number 2, post acquisition increase in other components of equity. Apart from this, non-controlling interest we measured from working note number 4, which is equal to working note number 4 valuation of non-controlling interest, that is 79360 is the valuation of non-controlling interest. Any non-current liabilities, current liabilities of parent plus subsidiary, current liabilities of parent plus subsidiary are presented. So this is how we present consolidated results and use these 5 workings to perform these consolidation procedures. So these PP intangible assets which I am talking about, this is actually the balances in working note number 2. The balance of land to be increased by 50,000, plant and machinery by 35, 50, 35, 15. $50,000 plus 35,000 and 15,000 in terms of intangible assets on the date of balance sheet. along with the existing intangibles. And in the deferred taxes, in non-current liabilities, deferred tax liability balance, whatever is the balance, this will be included with the deferred tax liability balance, which was included in working note number 2. Working note number 2, the deferred tax liability balance of 20,000 to be included in the balance sheet. It was P plus S plus 20,000 included from working note number 2. Same here on the asset side, P plus S of PP, intangibles, P plus S plus this date of balance sheet increase in fair value on the date of acquisition. So this is how we prepare consolidated financial position, and the role of these 5 workings into preparation of consolidated financial statements. If you remember these 5 workings, you can easily perform a consolidated statement of financial position question. So you simply need to remember group structure, the net assets to subsidiary on date of acquisition, goodwill, valuation, fair value basis or proportionate basis, valuation of NCI. This determines valuation of goodwill, and finally group retained earnings. So with this, I come to the close of the session. I would request you to use the code ACCA Amit to subscribe to the courses on Unacademy relating to CA final financial reporting based on Ind AS. And if I talk about my experience, I've been training on IFRS and Ind AS since 10 years now. Since my career began with IFRS trainings, and since then I have taught thousands of chartered accountants, was part of TMF Group, XSS Consulting, KPMG, was one of the lead trainers at KPMG. Until recently, I was the director with Accounting Advisory Services, BDO India. So to subscribe to my courses on Unacademy, you should use the code ACC Amit, and do not forget to follow me on Unacademy. So this is all for the day. Thanks for your valuable time. See you again every day. I'll be meeting you tomorrow as well, and will be continuously meeting you on Monday, Tuesday and Wednesday for the insights relating to Consolidation. So thank you so much. Thanks for your valuable time. See you again.